Hi everyone, welcome back to Accounting and Tax Helpdesk podcast. I'm Nima here with Haas, my business partner. I'm going to talk about tax and Haas is going to talk about CFO services that I don't know what it is, but it sounds very exciting. I know about tax, not CFO, sorry. Just to mention, we're here to talk about today. If you listen to my last podcast, I talked about the C corporation, its advantages, and today I'm going to talk about the pass-through entity taxes. What are the pass-through entity taxes? The pass-through entity taxes is the one that passing through income expenses. It's like passing through.
Passing through who?
To the personal level. So it's like, look at the C corporation, they hold everything unless they have to. But the pass-through, they passing through. If their company is sad, your pass-through entity is sad, it's passing through the sadness to you. If they're happy, making good money, they're passing through money and income to you. So passing through to you everything. What are the benefits? There are a lot of benefits on pass-through entities. That they're not in C corporation, then we're going to talk about it, dive into it. As I spoke about it last time, you don't have to create an entity enabled to deduct your expenses or write off expenses. But if you need a legal protection and some tax benefits in some cases, it's better to start your corporation, LLC, or S corporation. So let's talk about pass-through entities. What type of pass-through entities are? Partnership and S corporation are the main parts of those pass-throughs. And then just remember, S corporation is not a separate legal entity. It's just the election only for tax purposes. It's an election. You can have it on your C corporation or LLC. You can elect to be a S corporation. But we will dive into it. What's the benefit of the S corporation and LLCs? So let's start with the S corporations. And then with the same scenarios we talked about it in the last episode about the C corporation, that your corporation making good money.
The happiness part.
Yeah. So you want to passing through your happiness more to your personal. So on your C corporation, you have, if you are less than 100 shareholders, and if you are listening to the podcast, your business is for more sure has less than 100 shareholders. But what you need to do is just you need to elect to be taxed as a S corporation. You don't need to create a new entity. You just can use the same C corporation you have, and you can elect to be S corporation. And from that point, you're a different person. Your income expense is going to be passing through you personally. And you can take benefit, and then you're going to tax on just one time on the personal level and the tax bracket that you have personally. There is no double taxation, and you just pay taxes. And why S corporation? Why not LLC? So it comes to another concept of tax, self-employment tax. Always people talk about income tax and all they know about income tax, but there is another level of tax, self-employment tax. When you get if you work somewhere, you're a W-2 employee. If you make $10,000 a month, your paycheck doesn't show 10,000. It's some deductions. You will see it. You look at your paycheck. Oh, there are some deductions. Social security taxes, Medicare taxes. These are called self-employment tax. So, if you have an entity or business, you're not exempt from the self-employment tax. Actually, you have to pay self-employment tax from employer portion and employee portion. But that could be expensive. If you plan accordingly, you can save a lot of money on the self-employment tax, and that's what S corporation play an important role in that saving. That's actually the main benefit of having S corporation is saving on self-employment tax. Let's see how it works. So we talked about it last time. You have a C corporation. You can zero out your profit by just issue your salaries and zero it out. But all of those, your salaries, you have to pay self-employment tax. To some extent, you need to pay Social Security tax and Medicare tax. But if you plan to be S corporation, you don't, to some extent again. So the income you take out, you earn from a S corporation is not subject to self-employment tax. And that sounds great. But IRS said no. Okay, you still need to have some reasonable salaries in S corporation. So you cannot avoid the self-employment tax 100%. So S corporation beneficial for self-employment tax, but you still have to have a payroll, and it's a must. If you have an S corporation, you must set yourself a payroll. To the extent of your payroll, you pay self-employment tax. The rest is free of self-employment tax. Let's say before the S corporation, you make $100,000 net profit. All of those 100,000, if you're a LLC or you're a C corporation, you want to issue a salary, all of this is subject to self-employment tax. Means you have to pay self-employment tax, 6.2% social security tax, 1.45 Medicare tax, and in addition to that, you need to pay the employer portion the same amount. So it's going to be a 12, 13% of additional tax. How to avoid that? S elections. If you make a S election, let's say the same scenarios, you make $100,000. I would say I make a reasonable salaries, $20,000 to myself. I issue a payroll, pay self-employment tax on that $21,000. The rest, $80,000, is free of self-employment tax. You don't pay that 15% self-employment tax. So that's great. And the question I get, what's the reasonable salaries? And for that, again, it should be reasonable. There is no straight answer. Should be make sense. If you're an attorney, you cannot have a 10,000 reasonable salaries because there is no attorney makes 10,000. So it's a little subjective. Make your judgment. Make reasonable salaries, but that's the way you're going to help you to save self-employment taxes on S corporation. What other benefits of pass-throughs, including S corporation? You're passing through the income to the personal level. You get benefit of qualified business income deduction. It's 20%, it could be up to 20%. You don't have that options if you get the W-2 salaries or if you have a C corporation. So in pass-through entities, you can take advantage of 20% deduction. In some cases, it's gonna phase out, but a lot of cases, you can use that 20% additional deduction. But other options you have, like for a S corporation, there is in California, for example. If you live in California, you have options to pay your state individual income taxes from your corporation. What does it mean? Like, let's say government said, going forward, you can, if you pay for your groceries from your corporation, you get a deduction for that. That's same, like pass-through entity tax. Let's say it's a grocery shopping. I say, oh, from now on I can deduct it. So from now on I pay my state tax, income taxes to the some level from my corporation. I get a write-offs.
The write-off people.
Yeah, the write-off, the thing that everybody talks about write-off, and they don't know what write-off is. But sometimes all of those write-offs is gonna add up. All right, so enough about, for this episode, enough about the S corporation. Now let's take a break from S corporation. We will dive deep in the future episodes about S corporations, write-off, pass-throughs, but let's switch to Haas and talk about the exciting world of CFOs, how to save and how to manage your cash or any other things that Haas is expert.
Thank you, Nima. I appreciate it. I learned a lot. So last episode I talked about the forecasting your cash, and if you haven't listened to the last episode, feel free to go to check it out. This episode I'm gonna talk about the metric called cash conversion cycle. It's an accounting KPI I track for all of my clients, and I advise everyone out there to keep track of that KPI. It has three part. This formula has three part. If you have a inventory, three part. If you have a service industry like us, it's two part. It's basically is how when you purchase an inventory, at the time of you pay the cash to your supplier, you get the inventory, and that inventory gonna sit on your shelves for a period of time. That's one portion of this formula. The second portion, when you sell the inventory and get it issue the invoice. So, and from that time to the period that you collect your cash, that's your AR. So that's the second part. And the third part, it's the how long it takes you to pay your vendors, utility, all the fun parts. So that's the last piece of the puzzle. If you don't have inventory and you're in accounting, like service industry like us, you don't need to worry about inventory and just get your AR and your AP. So if you add your inventory cycle, add it with the your AR cycle and subtract the AP cycle, that's your number. So for example, if the inventory sits at your shelf for 20 days and 30 days for you to collect your cash from your customer and only gonna pay you takes you 10 days to pay your suppliers, that number is 20 plus 30 minus 10 is 40 days. The goal for every single business is to reduce this number as much as possible. There are ways to do that. The first thing is, I advise all my clients, pay your supplier on time, on the due dates, not a day sooner. And if you can, pay it with your credit card, so you extend the cash flow outgoing out the door by the credit card statement due dates. So that means you have the money in the bank account, you can park in the money market account, which is the kind of saving account with the higher interest. You collect interest on that. And also, you have the cash in the bank for something emergency happen. You can always negotiate a deal with your vendor if you don't have to pay them, but if something emergency happen, you have the cash reserve. The other thing I tell my clients always is try to optimize your AR collection. You don't need to call your customers, hey, pay me. My invoice is due 10 days ago, why you haven't paid me? So there are software out there that you can collect your customer credit card information or bank information, and it's all secure, all encrypted. You have to pay the subscription fee for the software, but then you have the software to charge your clients on the due dates automatically, so you can collect your cash. And if you get the decline notification from the software, that's the time you need to call your customer, like, hey, my invoice got declined, my payment got declined. Do you have a issue on your cash, or you just have a expired credit card? So these two simple things can boost your cash flow, and
Yeah, they adds up. Yeah.
they adds up. And the KPI always at the end of each month, have your bookkeeper or accountant get you that number and manage it and compare it to last month. And the goal is to minimize that number as much as possible. If your cash conversion cycle is like 60 days, you're gonna be in trouble. There's no doubt on that, unless you have a massive amount of cash reserved from your family. But if you're operating a company and you strap the company 60 days cash flow conversion, you're gonna have trouble.
There is something I just want to add. It's just sometimes clients need to know all of those small steps. They adds up. It's like going to the gym. If you go to the gym one day, it's not
Yeah.
gonna work out. But every day, consistent. If you do those small steps, they're gonna add up. So all this accounting or tax saving or anything about accounting, all of those simple steps that people don't think about it and they don't see that much value, they're gonna add up. That's how we're gonna have a healthy financial statements. It's not, there is no magic. You cannot, like, there is no magic way to just have save on taxes, your boost your cash management. There is a just start having a healthy financial habits, like any other aspect of life. Sorry for
Yeah.
interrupting.
No, thank you. It's all about discipline. You have to have a high discipline. Thank you everyone for joining us at Tax and Accounting Helpdesk. As always, it means a word to us if you drop a comment, like, share, subscribe. You can reach out directly to us via the comments, DM us, send us an email at helpdesk@alarmrecipients.com. We'll get back to you with your question answer in this podcast. Talk to you next week.